All right, so let's now proceed to the standard costing control loop. So the standard costing control loop is actually the process by which management addresses and controls the costs, right? So this is a systematic five-step process which provides a framework or a backbone for management to follow, right? So first step here is to establish the standard or to define what actually are the standards. So at establishing the standards, there are actually two types of standards which management can choose from. First is ideal standard or the theoretical or maximum efficiency standards, which provides no allowance for typical or expected machine or direct labor downtime. All right, so entirely no downtime in the manufacturing line. Or on the other hand, management could also establish practical standards, which allows for normal downtime. So again, by the term itself, in practice, practical standards are the ones which are being used. Of course, as contrasted with the ideal standards, they are ideal, which means they cannot be expected to occur in the real world or in the actual manufacturing line itself, right? Right. So just a few notes when it comes to establishing standards. A company employing very tight or high standards in a standard cost system should expect that most variances will be unfavorable. So when the company employs very tight or very high standards, you would expect that the standard costs applied to actual production would be lower, right, than what is practically attainable. Which means that most of the time, the actual costs incurred in production will be higher than the standard costs itself, which would lead to an unfavorable variance overall, right? Next, ideal standards ideal standards demand maximum efficiency, which may leave workers frustrated, thus causing a decline in the performance. Again, tying back to the definition of an ideal standard, as it is really not attainable during actual or normal production. This may leave workers frustrated as they may feel that they won't be able to achieve the standards set by management. Next step is after establishing the standards, management should measure the actual performance. So when we say actual performance, we are relating to the actual costs in the manufacturing line, which refers to our job order or process order costing system. Next, we compare the actual performance with the standard. This is actually the step wherein we would be measuring the variances or computing for the variances. Next is to analyze and investigate the variances. So after the computation of the variances, management should be able to assign the responsibility over the variances to which particular department this variance belongs. And then of course follow through on that. In the last and next step, which is take action and make decisions. So in this last step, this may include reassessment of the established standards. All right. Next, we just like to differentiate or provide the concept behind the differentiation between standards and budgets. So a standard is a unit amount, okay, while a budget is a total amount. So in the problems we would be encountering later on, if we use the standard, there is an assumption that we are pertaining to a per unit amount, whereas a budget would be a total amount. Of course, this may be different if, for example, the problem provides per unit amount of the budget. All right, so there may be cases wherein we would be trying to compute for the total budget amount using the per unit amount given. Next, total budgeted cost is the cost that should be incurred for budgeted production. Okay, so when we say budgeted production, we are normally pertaining to the normal capacity of the plant in production, right? So normal capacity, just remember. So budgeted production multiplied by standard cost per unit would equate to our total budgeted cost. Total standard costs, on the other hand, are the costs that should have been incurred for actual production, right? So what's different here is actually the production capacity used. So for total standard cost, it is actual production times standard cost per unit. So again, similarly, to arrive at the budget variance, we deduct the budgeted cost from the actual cost, and to arrive at the standard cost variance, we deduct the standard cost from the actual cost. Okay. Next, we now proceed to our second learning objective, which is the computation of standard costs and variances. So, for variances, basically the definition is that it is the difference between actual costs and standard costs. It can be described either as favorable, actual cost would be lesser than standard cost, which means that the company spent less than what is expected through the standards, means it is favorable to the company, or it may be unfavorable, wherein the actual cost is greater than the standard cost. Okay, this means that the company spent more than what they are expecting. Alright, so at this point, before we actually proceed to the computation of variances, I just like to group, okay, the variances into its categories, which follow basically the same approach in computing for the variances and in interpretation as well. Okay, so first group is more on the variable natured costs, which are direct material, direct labor, and variable factory overhead. Next is the fixed factory overhead, is of course different from the first, which is wherein it is fixed. Next is the total factory overhead. So since the total factory overhead has a fixed component and a variable component, it might also be different, or I mean, the approach might also be more complicated than the two previous ones. And then lastly here, if there are more than one material used in production, we could also compute for the material's price, mix, and yield variances. Okay. Okay. Alright, so before we actually proceed to the computations, let's tackle on a few practice theory questions. First here, which of the following is a purpose of standard costing? A, to determine break-even production level. B, to control costs. C, to eliminate the need for subjective decisions by management. Or D, allocate costs with more accuracy. So the answer is, of course, B, to control costs, which is the primary purpose of using standard costing. Right? So just to provide an explanation why the three different answers or choices are incorrect. First, it does not provide or it does not guide management in determining the break-even production level. Again, in cost volume profit analysis or in break-even analysis, we are actually breaking down the total actual costs of the company into its variable and fixed components. And then afterwards, we will be making use of those costs along with the prices to determine what is the break-even production level. So there are no standard costs used in CVP analysis, whereas in standard costs, we are somewhat only focusing on the total standard costs and the actual costs of what approach we are using. Like for example, if we are trying to compute for total factory overhead, we are focusing on the variable and fixed components. However, we are not trying to compute for the volumes at which the production line would break even. Alright, so the break-even analysis or the CVP, cost volume profit analysis, would be covered in a different topic. Next, letter C, to eliminate the need for subjective decisions by management. So this is not true, because the use of a standard cost system would still need subjective decisions by management, wherein first, in establishing the standards itself, so we mentioned earlier that there are two options provided to management in choosing what standards to establish. So right then and there is already a subjective decision to be made by management. But then afterwards, once the variances are computed, management would also decide on which variances are significant enough, right? So remember, management by exception, only those variances which are material or significant enough would be accounted for or would be investigated. So again, there is also a subjective decision to be made by management there. And then lastly here, allocate costs with more accuracy. So again, cost allocation is not the main purpose of a standard costing system. It can only be considered one of the aspects which is more tackled on or is more directed towards job order costing or a process costing system, which provides cost allocation. All right. Next theory practice question here. Which of the following should be least considered when deciding whether to investigate a variance? A. Whether the variance is favorable or unfavorable. B. Significance of the variance. C. Cost of investigating the variance. And D. Trend of the variances over time. So answer is A. Whether the variance is favorable or unfavorable. Again, we discussed earlier that whether or not the variances result into favorable or unfavorable, it does not change, or I mean, it does not affect management decision whether to investigate it or not. Okay, because again, both favorable and unfavorable variances should be investigated by management to maximize its economic, effectiveness and efficiency in its production line. Now, why are the three other choices not correct? Because the significance of the variance is actually the main or the primary factor in considering what variances to investigate. So again, tying back to management by exception, wherein only those variances which are significant enough to prompt management decision would be investigated. Next is the cost of investigating the variance. This would also impact management's judgment on whether or not to proceed to investigate the variances itself. Of course, it would only investigate variances which are practicable, to investigate, which would, provide a net benefit to management. And then lastly here, trend of the variances over time. This would also provide a sound decision to management wherein the total trend of the variances over a particular accounting period would, some sort of provide a clue to the future state of the manufacturing process. Just to give an example, if variances have been unfavorable for quite some time, like for example for the past 6 months, they have been unfavorable, although they have been insignificant or immaterial or below the threshold, it may lead to a material or significant total variance at the end of the year. So in that sense, since the last 6 months have already provided unfavorable variances, that might lead or prompt management to, conduct an investigation already on what has actually been causing that trend. All right.